Welcome to Financially Speaking, brought to you by Buska Retirement Solutions and its affiliate firms. We offer retirement, tax, and legacy planning from a dedicated family-built team. In today's episode, we'll focus on how to manage health insurance before Medicare kicks in, how to plan ahead so those costs don't catch you off guard, and whether or not you should consider investing in the market during retirement. And now for our weekly question and answer segment.
Welcome back to Financially Speaking. Today I'm here with Ryan Connor and Logan Waller of Buska Retirement Solutions and Buska Wealth Management. In this segment, we're focusing on a key challenge for early retirees, and that is how to manage health insurance coverage before Medicare kicks in. I want to retire. I'm done with the job. I'm done with the working world. I got enough, but health insurance is a tricky one. What options for health insurance do I have if I retire between my company plan and my Medicare?
Yeah, so one of the biggest reasons why folks typically think they need to wait till 65 to actually retire is the health insurance component. Because they're thinking, oh, I've just got to get to Medicare and then I can retire because I don't have to worry about the health insurance piece anymore. But there are multiple different options you may have depending on your circumstance. Now, the first one might involve not actually changing your health insurance plan at all. So some employers, as part of their retirement package, if you work for a certain number of years, will actually offer you your insurance to carry you through until the point at which you reach Medicare. Those aren't super common, but it is worth checking in with your employer to see if that is an option, because it allows you to not switch your coverage, not have to switch your doctor, basically stay in the same plan.
Yeah.
Exactly. And then now the other options, which are going to be more common, the most common one is you're going to look for a plan, most likely on the Affordable Care Act marketplace. Healthcare.gov, our health insurance folks here at Buska help our clients kind of try and navigate that, because as you go in and enter information about, your income, your household, your age, and a couple of individual circumstances, it's going to provide you with, in some cases, dozens of plans depending on your zip code.
Okay.
And that can be pretty difficult to navigate on your own, but that's why I know it's nice to have specialists in that regard to help you figure out what plan's going to be right for you. And the final option that most folks would possibly look at would be something like COBRA. So COBRA is basically continuing your coverage within your employer plan, but the employer stops paying their part of the premium, and you are going to have a small administrative fee typically tacked on top of it. So COBRA premiums can be quite expensive, which is why for most folks that's not going to be the option we're going to want to utilize. But in a worst case scenario, there is a fallback option there, which will provide you coverage for typically 18 months.
Okay. And I would add too, it's just really looking at the circumstances before you get in. So one thing I think you might have not mentioned is just going on to your spousal benefits. But sometimes certain companies will have a bigger expense but having your spouse come on, so that's where it could make sense to not do that and go onto the open market, but it's all situational, of course.
No, that makes sense, and despite what you guys may think, I'm not exactly a specimen of health, right? So how does my health insurance premiums impact my retirement savings?
Yeah, so really depending again what route you go, but if we think about going onto the open market, they really base it off of three main ideas, and the first biggest one is your income. So when we're in retirement, but we're not Medicare age 65 yet, we want to strategize for how we're paying for our expenses, but keeping our income low. So what isn't that taxable income? So that way it can keep our premiums low. And then we're looking at what type of medications you're on, if you're on that commercial drugs, or we call it the tier 1. And then also looking at how often do you want to go to the doctor? What do you want your deductibles to be? Yeah, right.
I have bad news for you about the medical needs of folks in their 60s.
Yes. So it's really just planning ahead and then using those tax strategies to really keep that income low until we get to that Medicare age.
That makes sense. Now, are there penalties for retiring early if I'm not on Medicare? Does I pay a health insurance penalty? Or?
No, so there's not going to be any penalties for retiring before Medicare, and retiring, let's say if you're 62, and not Medicare eligible until 65, it's not going to alter your Medicare situation whatsoever. You're not going to pay any penalties for that. Really, the kind of penalty you have is that you'll probably be responsible for your own health insurance. So that'll involve, the premiums depending on the plan you choose, which is going to be dependent on a bunch of the different variables we just talked about, primarily income, particularly gross income. So there are some strategies we can use to try and make sure that your standard of living remains the same, which I'm sure we'll get into, but kind of showing your income to be whatever level it needs to be. So you're not looking at any penalties or change to your Medicare situation long term, simply by retiring before you are actually Medicare eligible. All of that's going to be unaffected.
So obviously you guys have done this before. For most people like me, others you probably meet with, we've only dealt with our company plan. It costs X, we pay X. We just move on and keep going. You got cash flow coming in, it comes out of your paycheck. You don't know how it works. How do I even start planning for what you guys just said?
Well, it all begins.
That's a lot.
It is a lot. And it all starts with sitting down with a financial person, a financial representative to plan before that happens. Because you have these different health accounts out there. The most popular, and I think one of the best, is the health savings account, HSA. You build that up over your lifetime. Now you retire at 62 or before Medicare age. You can use that HSA to pay for those premiums that were growing tax-free during that time. So that's an important piece, is just planning ahead. We see a lot of times too where folks will retire and go into the open market, and they sometimes have the same insurance plan they had at work,
Oh, really?
but now they're paying no premium because of how the system works. So if there's any fear out there of, hey, I have to work till 65 to get the Medicare and not have to deal with this big expensive health insurance, that's a little bit outdated news since the Affordable Care Act came into place.
Okay. As I'm looking at different plans, is that something you guys help with as well? Not only the financial side of things, but figuring out how the health insurance actually works?
Yeah, so in both of our offices, we actually have dedicated health insurance specialists. So that's something that when I'm working on a financial and retirement plan, I will actually pull into those meetings to help, basically test out some different income levels. Like, hey, if our income is going to be X, what is the impact that that's going to have on our health insurance costs in terms of premiums, in terms of deductibles, in terms of out-of-pocket maxes? And how much the premium, deductible, and out-of-pocket max matters to a particular client is going to depend on what their expected medical needs are going to be.
Got it.
If you're someone who is healthy, you don't take prescriptions, you don't anticipate really needing to go to the doctor very often other than just for kind of your standard preventative care, maybe you want to opt for a lower premium plan. If you're someone who knows that, okay, I have some conditions, I'm on medications, I'm going to be seeing specialists pretty regularly, maybe you want to go on to a higher premium plan that comes with some smaller copays, potentially lower deductibles, lower out-of-pocket maxes. Because what we're trying to do is not always just lower the premium down to the floor. What we're trying to do is reduce the amount of expenses you're going to have from your healthcare overall by whatever means we can. And so a lot of times people are always trying to chase that rock bottom premium.
Sure.
But it's about thinking from a more holistic perspective. How can I spend less money on this, service that I am, going to need at some point?
Right, and getting the right one.
Exactly.
Good. Well, I appreciate that. After a brief break, we'll get back to our chat about how proper planning can help close the coverage gap and protect your retirement income from medical expenses. Stick around. We'll be right back.
Do you have a plan for how your assets will be handled after you're gone? Without one, the state could end up making life's most important decisions for your family. Through our partnership with Estate Guru, we make a estate planning process simple and affordable, offering wills, powers of attorney, and revocable trusts. On average, our service costs 70% less than the traditional estate attorney fees, and you may even qualify for free financial and healthcare power of attorneys. Call our office today to get started.
And now back to our weekly question and answer segment.
Hello again. Let's jump right back into talking about the cost of health care in early retirement. Before the break, Ryan and Logan discussed what options exist before you're eligible for Medicare. Now let's expand our conversation about how to plan ahead so those costs don't catch you off guard. We talked a little bit about this, but let's get back into this. What is the difference between COBRA, ACA plans, the private marketplace you talked about? What is the major difference in all those?
Yeah, so COBRA, COBRA's been around for actually several decades, is basically you continue on your employer coverage, as is. So the plan rules, your deductibles, out-of-pocket maxes, everything, are going to stay the same. You're going to be within the same plan. But because you're no longer employed with that employer, the employer doesn't have to pay their portion of the premium, which, depending on how much your employer is contributing to your health insurance, may not be very much, and it may be quite a bit. And so you basically pay the full boat for the premium, and then they actually do tack on a small administrative fee on top of it. It's typically going to be an additional 2%. Because of all those different factors, COBRA premiums are typically going to be pretty high. It's in most cases we're able to find less expensive insurance through other means, but it is kind of a fallback option, and may become more relevant here after the Affordable Care Act premium subsidies expire at the end of this year, especially for those who have higher levels of income and may not qualify for premium subsidies. So the Affordable Care Act marketplace, that's when people talk about the insurance marketplace, that's really what they're talking about primarily. You go on healthcare.gov, you enter your information, you get a bunch of, in some cases dozens of plans depending on your area. Sure. Can be kind of confusing to navigate if you're not sure what you're looking for. But with those are going to be health insurance plans that are offered through private companies that meet the criteria of the Affordable Care Act, which was passed, about 15 years ago now. And those are going to be plans that qualify for a potential premium subsidy. Basically, the level of coverage that they provide meets the criteria within the Affordable Care Act to potentially qualify for the premium subsidies, therefore reducing the out-of-pocket costs of the health insurance. Now, depending on your level of income, which is really like the important part when it comes to the Affordable Care Act, your premium levels for various different plans are going to be at various different levels. And this is where the planning part is extremely important. Huge. Because if you're, not planning ahead for this, not figuring out different potential tax strategies to try and account for this, you can end up paying a lot more in health insurance than you otherwise would need to. The final place is going to be the private marketplace, which is basically going to be health insurance plans that are offered through private insurance companies, so the same as the Affordable Care Act plans, but they don't meet the coverage requirements to receive premium subsidies. And so those are not super typical as far as what we use, because usually we're able to find better coverage, better rates and everything through the Affordable Care Act. But it is an additional option for folks if the other two don't work out for whatever reason.
Makes sense. Now, I know you said we're not trying to chase the lowest premium out there. That's not the goal. But, A, I'm cheap. B, I just retired. I have no job. I'd like to lower the premiums as much as possible. What other strategies? You mentioned showing less income through tax strategies. Anything else I can do to lower premiums?
Really comes down to it's all about the planning. There really isn't any other strategy other than planning ahead. But if we don't, then that's where we're adjusting the plan to maybe use more of our non-qualified assets to pay for our expenses, keep that income low. But a lot of times it's just being strategic. Let's get all the big health needs we need to get done and checkups and all that before we retire when we're still on the employer benefits. So get those if you haven't gone into the doctor for a while because you don't like to go. Well, maybe it's time for that checkup in the beginning of the year if you plan to retire at the end of the year. So it really just comes down to that strategy and plan before you enter that world.
If we can, you mentioned tax strategies, you mentioned non-qualified money. Yeah. Again, you guys have done this 100 times, but for me, I've never done it. Give me an example of the tax strategy of non-qualified versus, you mentioned IRAs, give me an example of how that would play into my income.
Yeah, so Logan mentioned non-qualified funds, which can be useful, but on that can get complicated because it depends on if you've got gains or losses and exactly what type of non-qualified money you're using. Are they securities? Are they, money markets? Are they CDs? That's the stuff that we all try and we'll figure out and manage with every individual plan. But the whole idea behind it is you want your adjusted gross income, which is going to include, withdrawals from your pre-tax IRAs. So IRAs, most 401k dollars are going to be pre-tax, 403b deferred comps. Mm-hmm. It's going to include, if you're receiving Social Security benefits, it's going to include those dollars. It's going to include pensions, exactly, as well. What it's not going to include is, withdrawals from those non-qualified accounts If they're not gains, so if they're securities and they've had gains, then that gets a little more complicated to figure out, but not, too terribly difficult. The big piece that we really recommend utilizing during this time is going to be Roth money. Because Roth money, you have already gotten through the tax door. And so the withdrawals that you make from there to supplement your income are not going to therefore kind of count, and because you've already paid taxes on them before. So you can effectively keep your same net income, which is ultimately going to dictate your standard of living while you're retired, without increasing your health insurance premiums. So if you have the ability to plan ahead well in advance, look at options for Roth contributions or Roth conversions before retirement.
I was going to say a conversion
utilizing those dollars.
Because if I don't have a Roth, I can set one up beforehand, true?
Correct. Two ways to fund a Roth account. One is new money going in, and you have limitations each year, whether it's through an IRA, individual retirement account, or through your employer-sponsored plan like a 401k, 403b. The other way is you have that pre-tax money. Your whole life you heard, put money in, don't pay taxes yet, because the theory is when you get into retirement, you have a lower income threshold, so you pay taxes at a less rate. That's not always true, especially if you have a pension or taxes go up, especially with the debt deficit we have as a country. Yeah. But we can take that qualified money, move it over to the Roth side, and we pay taxes as we do that. There's no limitations on that to do the Roth conversions. However, if you move 200 grand from your pre-tax side to your Roth side, the IRS is going to count that as income in that year. So now they put you into a higher tax bracket for that year. So again, I feel like I'm beating the drum here, but it's just planning ahead and really sitting down with that professional to talk through those strategies.
Okay. Well, perfect. Well, I think that brings us to the end of it. So I've learned two things. One, different types of health insurance plans after I retire. And two, call you guys before making any decisions. Fair?
I think that's a good
fair.
idea.
We'll be right back after this break.
At Buska, our goal is to streamline the retirement planning process to help you move towards a successful retirement with confidence and ease. Through our 3 companies, we provide a comprehensive approach to planning your future. We work closely with you to create a personalized, comprehensive retirement plan that reflects your unique goals and financial situation. Our team integrates investment management, income planning, tax strategies, estate planning, health insurance, and Medicare planning all under one roof. That means fewer appointments, less stress, and more clarity as you prepare for life's next chapter. Whether you're just starting to think about retirement or looking for a second opinion on your current plan, we're here to help you feel more confident about your financial future. Call us today at 715-355-4445 or visit retirewithbuska.com to schedule your complimentary, no-obligation consultation. Let's make retirement planning easier together.
And now our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Cole Bruner from Buska Retirement Solutions and Buska Wealth Management, and joining me today is Ryan Connor. Today, Ryan and I are going to discuss whether investing in the market during retirement is a smart move.
That's right. An Investopedia article titled, "Should You Invest in the Market During Retirement?" grapples with this question.
So what's the first thing that you should do if you're thinking about investing during retirement?
Investopedia recommends defining your retirement investment goals. How will you cover essential and discretionary expenses when you're no longer working? How will you prevent your money from running out?
Well, those are all excellent questions. So what about figuring out your risk tolerance? Is that a goal that people should be focused on?
Absolutely. In my opinion, it's almost always a good idea to know your risk tolerance, but it's even more important in retirement. When you're not working, it's important to preserve your capital. How much can you risk putting on the line? And would a less aggressive investment strategy be better for you in retirement? If you're okay with a lower return in exchange for lower risk, that may be the way to go.
You also need to know your risk tolerance before you decide what your portfolio's asset allocation should be. If your risk tolerance is low, you might not want to put a high percentage of assets into high-risk stocks.
Now, on the other hand, if your risk tolerance is higher, you may want to move some of your money into riskier options rather than keeping it all in low-risk vehicles. Otherwise, you could miss out on possible gains.
So what if people have no idea what their risk tolerance is? How do they figure that out?
So they can talk to a financial services professional. In fact, if they go to our website, retirewithbuska.com, they can complete a color of money risk assessment, and it's a short questionnaire that shows them what their risk tolerance is. It's quick, it's easy, in its painless way to gain essential insight into one's risk tolerance.
I agree. In my opinion, the Color of Money risk assessment is a great way for people to start their financial planning journey. Like you said, Brian, you shouldn't allocate your portfolio before you're knowing your full risk tolerance, obviously.
Exactly.
So let's talk about the case for investing during retirement.
It's a way of generating income and letting your savings grow while you're in your post-work years.
And those post-work years can last a long time. If you have a 30-year retirement to fund, then it makes sense to maintain a solid portfolio. The dividends and interest can provide the income that you'll need to keep going as you continue to age.
It's also a way to protect yourself from inflation.
That's right, Ryan. We've talked a bit already about asset allocation, so let's talk a little bit more about it in detail.
Well, as the article points out, if you have all of your money in either cash or bonds, you may lose purchasing power over time.
So why is that?
Because inflation can eat into the value of the money that you've saved. Money invested in stocks can grow more on average and help you stay ahead of inflation. As the article states, bonds can help provide some stability to your portfolio, while stocks can provide the long-term growth.
Well, that certainly makes sense to me. So what's the next step that Investopedia recommends?
The article mentions focusing on index investing.
So explain to our viewers what index investing really is.
So it's a passive form of investing that focuses on low-cost index funds.
Sounds like index investing could work for retirees, but there are many other factors to consider here.
That's right.
So this is where working with a qualified financial professional can really help to avoid making emotional decisions. Remember, emotional investment decisions can lead to damaging consequences.
That's a great point, Cole. Individual investors trying to actively trade stocks on their own can be both time-consuming and stressful.
Time-consuming and stressful. That doesn't really sound like something people want as a part of their retirement.
Spot on, Cole. Now, for retirees, that's why working with a financial services professional can help avoid emotional trading and the stress that comes with it.
All right, so we've reviewed our asset allocation and emotional investing. So what's next?
Rebalancing your portfolio on a regular basis is probably a good idea.
So what does it mean to rebalance your portfolio?
Think of it like this. When you have your piano tuned, the tuner makes adjustments to make sure that each note sounds exactly the way it should. Rebalancing your portfolio ensures that your investments continue to align with your goals long term.
If your investments are out of line with your goals, you could start hearing some sour notes potentially.
Yeah, exactly.
So how do rebalances typically work?
So it usually involves selling off investments that have increased in value in the short term and then reinvesting that money in vehicles that haven't performed as well over that period of time.
Yeah, that's true.
As the article states, it sounds counterintuitive, but it does work. At the end of the day, rebalancing your portfolio means that you're going to have the right combination of investments, such as the right amount of fixed income securities, equities, and so on.
A financial services professional can really help with rebalancing.
Absolutely. You don't have to go it alone. In fact, letting a professional handle your rebalancing can eliminate a lot of the guesswork on your end.
Well, Ryan, let's revisit the issue of active trading. We talked a bit about it earlier, but let's help our viewers understand the pros and cons of active trading.
I think that's a great idea. Now, one of the downsides of active trading is going all in on one stock. These blue chip stocks may seem like a sure thing, but if you put too much into it, you could be exposing yourself to a significant loss of your nest egg at a time when you can least likely afford it.
So if you're withdrawing money regularly, which you must do if you're taking required minimum distributions, it can be even harder to recover from a loss like that.
That's right.
But what if someone feels like they need to trade actively?
In that case, it may be a good idea to limit the amount of money that you trade with on your own, or to work with a qualified financial professional to assist you with a more actively managed strategy.
Active trading without the guidance of a professional should be a small part of your overall investment strategy.
Absolutely. If you even do it at all.
So what if I don't want to engage in active trading on my own during retirement?
In my opinion, that's perfectly fine. That is why we suggest having an actively managed portfolio that is overseen by a skilled professional.
Well, let's switch gears a bit and talk about taxes.
Yes, taxes can eat into your retirement income, and you can't necessarily make them go away altogether, but you do have some control about when you pay them, and in turn, you can help protect your nest egg by doing it right.
Can frequent trading expose you to capital gains taxes?
It can, yes. In fact, one of the ways to avoid capital gains tax is to have money in a Roth IRA. That money grows tax-free, so that when you take it out, you don't pay any taxes on it.
Well, what about converting another retirement account into a Roth IRA?
That's certainly an option. Now, it may not be the best idea for everyone. This is definitely something you should discuss with a financial professional before just going ahead and doing a Roth conversion.
Let's talk more about taxes on withdrawals.
So when you reach your 70s, the exact age will depend on when you were born, you'll likely have to start taking required minimum distributions. When taking withdrawals from a traditional IRA or a pre-tax 401k, you'll have to pay taxes on each and every distribution that you make.
Your distributions can also push you into a higher tax bracket, so that's certainly something to be aware of and definitely plan for if possible.
Exactly. Distributions pushing you into a higher tax bracket can affect the taxes you owe on your Social Security payments as well.
So what's the takeaway here, Ryan? Should people continue investing after they retire?
The article says that it is a must for most retirees, and that makes perfect sense to me. It can help protect you from inflation, it can help increase your income, and it can also help you preserve capital. But you need to be mindful of what you invest in.
And try to make withdrawals more tax efficient.
Exactly.
So that does it for this segment. Viewers, if you have questions about your overall financial strategy, be sure to contact us at retirewithbuska.com or call 715-355-4445. We'll be right back with more of Financially Speaking after this.
If you're 59 and a half or have recently changed jobs, now might be the perfect time to consider a 401k rollover. Rolling over your old 401ks could simplify your finances and give you more control from investment options and costs to how and when you make withdrawals. A rollover could give you the opportunity to partner with a financial services professional and tailor your investments to your specific needs, not a company's group plan. Call our office today to schedule your complimentary consultation and see if a 401k rollover is right for you.
With recent market changes, it's understandable that some people are feeling a little anxious about their financial future. That's why now might be a perfect time to review your financial plan. A financial services professional is trained to help you stay focused on the facts, not emotions, when it comes to your strategy. Getting a second opinion today works to ensure your investments are properly positioned to weather market volatility and that you're not taking on more risk than you realize. Let's work to make sure your plan is ready for whatever comes next. Call us today to schedule a complimentary review with one of our financial professionals.
Thank you for tuning in to this week's edition of Financially Speaking. We're glad you were able to join us today, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. This is the same way that we communicate to our clients when we meet with them in person. Remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now may be a great time to get a second opinion on your retirement plan. So call us at 715-355-4445 or go to retirewithbuska.com to continue your retirement education, catch up on previous episodes of our TV and radio show, or schedule your complimentary no-obligation consultation.
And if you have any questions or comments about today's show, give us a call at 715-355-4445 or feel free to send us an email at info@retirewithbuska.com. Join us next week at the same time and same place for another episode of Financially Speaking.